Okay, we have roughly about 20 people joined in. We have more and more people coming in. So we'll do just a quick round of intro amongst ourselves, and then we'll quickly start in a couple of minutes. So I think everyone who is there on the call might or might not know me, but I'll quickly introduce myself. My name is Nilesh. I am the co-founder of Tradl AI. We are building an AI trading intelligence platform. The idea is to help traders derive real-time intelligence in their trading workflows. People who are very, very active in the market, people who are looking for opportunities, people who are looking for real-time AI-powered intelligence. That is something that we are going to provide through our platform. And we are just getting started. We have built a couple of AI tools which are available on our platform, Tradl.in. Some of you might have already explored it. Some of you might be new. So I would encourage you, post the session, definitely go and check out what we are building. We'll also have a quick demo of the platform associated to the theme of the session today. The theme of the session today is mastering factor investing. The team here, which we have, FactorLab, both Mani and Shekhar are available with us. So they are going to take through this entire session, describing about what their expertise is, why they chose to, go deep into the field of factor investing, how are they leveraging quant knowledge inside it, data-backed strategies inside it. And we will, towards the session, also get a glimpse of how you can use Tradl AI to assist your research in factor investing or factor-based trading. So that is something that we are going to cover. I will let Mani now take over and give a quick introduction about FactorLab and themselves, and then we can jump into the session and start talking about whatever they have to discuss and run through the quick demo towards the end of the session. I would urge everyone to just stay themselves on mute. Whenever you have questions, we have a chat open, so you can keep dropping your questions during the presentation and the session in the chat. We'll keep taking it up at the appropriate time or towards the end of the session. All right, cool. Over to you, Mani.
Yeah. So hi everyone, very good morning. Thanks for joining on a Sunday morning. In fact, 10 a.m. is still early morning on a Sunday. So really appreciate you taking time out to join this session. Myself, Mani Deepak, I am the co-founder of FactorLab, and we started this journey about roughly 1.5 to 2 years ago. And so we've been very active on YouTube, sharing our knowledge about factors. So do check it out. Check out our channel to understand more depth about it. So obviously this session is more about a primer for factor investing, but you can go further deep. You can see our data-backed analysis on our channel, and even Medium blogs. And my background, I'm a IIT Guwahati and ISB alumni, and I do have quite some experience, about 15 odd years experience in data science and data analytics. And I also have Shekhar with me. Yeah, so Shekhar, want to?
Yeah. So Deepak and I were colleagues back in 2010 at New Sigma. So that's how our journey started in analytics. And I'm a bit planning and analytics as a alumni. So we both have started this FactorLab 2 years back to broaden the research in factor-based investing in India and offer investment services to our clients in India.
Great. So with that, Nilesh, you want to get us started?
Yes, Mani.
Okay. So before we start, right, just quick read of the room. How many of you have been actively investing through factors? Like, maybe you can just type yes if you are already doing something in the space, or no if you haven't read a lot about factors or you haven't been actively looking at this space. Just give. Great. Okay, that's good. So I think most of you haven't looked at factors a lot. So this is how I'm going to plan the session. So we're going to start with how factors really came about, what is the background behind this, and what is probably give you a historical perspective as well. And then we'll start looking at how are factors performing, right? So unless we look at data and the numbers, it's really hard to explain why we are even looking at this concept called factors. And obviously, anything that gives you returns comes with certain challenges. So we're going to talk about what those challenges are and how we at FactorLab are addressing or trying to address these challenges. So this is how we're going to plan the rest of the session. So with that, let me get started. So any researcher in any field, right? So they try to, what do they try to do? They try to get answers or find answers to the most difficult questions in that field, right? And in this industry or in this field of equity investing, what is the most important question, right? So the most important question is, where do we get returns, right? So obviously we want to know, how can we actually explain returns to returns that we get from the equity markets, right? So we will time travel back to 1960s and talk about how factors really came about. So I'll just share my screen quickly. I hope it is visible now. I can see the screen myself. So
Visible.
yeah, great. So if you go back to the 1960s, and there's this gentleman called William Sharp who's been trying to answer this question, and all he got was a simple equation which explains returns. And anyone who has done corporate finance or quant finance in their careers would have seen this equation. It's called the CAPM model. And if you see on the y-axis, you have expected return. And on the x-axis, you have the risk, right? And what he's essentially trying to say is, if you're not taking any risk, what you get is a risk-free rate. And if you are taking market level risk, then you get market level return. And any extra return that you're trying to get beyond market return, you have to take extra risk, right? So you're essentially on this line. And if you are seeking a more higher return, then you obviously are going to see higher risk as well, right? So basically what he's trying to say is there is no free lunch. You get exposure to more risk if you are trying to get more return. Now, there are two researchers, Pharma and French, who are trying to really test this equation up to the T, and they found something strange, right? So they found that there is this factor called the size factor, where they've noticed that small cap stocks are performing better than large cap stocks over time. And that seems to be an anomaly. And if you have seen earlier the CAPM model, anything that gives you more return with not so much risk is basically taking a dig at the original CAPM model, right? So this is contradicting the equation that Sharp has come up with, and this is the first poke at the original equation. And they didn't stop at that. They looked at more such factors, and another factor that they found was the value factor. And basically what value factor says is that if you pick cheap stocks, right? So when I say cheap stocks, what I meant was, something with low price to book ratios, something with low price to earnings ratio, PE ratios, are beating the expensive stocks, right, consistently over time. Now, this is another anomaly and another dig at the CAPM equation. So this is enough evidence for Pharma and French to come up with another model, which is called the Pharma and French three-factor model. And basically what they're trying to say is that the original equation, the CAPM model, is not complete, right? So where they're trying to explain everything through market beta. And these guys said, it's not just market beta, you also have the size factor and the value factor that explain the returns that you get from the equity markets, right? So, and they have published this seminal paper in 1992 to basically explain the returns through these three factors. And they've been awarded the Nobel Prize for that. And in fact, Sharp also received a Nobel Prize for the CAPM model. And so I think so far we understood that there are these factors that are trying to explain the returns that we get from the equities. Now, what really are factors, right? So factors are essentially different investing styles which are defined by single or a set of numerical characteristics, right? So, I mean, any factor that you take should be backed by a set of numerical numbers or metrics or ratios that try to explain the factor or define the factor. And if you have read this fact that even Ben Graham, the father of value investing, used to have formulas or metrics to identify value-based stocks, right? So he's a big believer in value factor, and even for that matter, from Warren Buffett to Rakesh Jhunjhunwala in India, everyone of them are value investors, and they do have certain numerical metrics to measure value. And it didn't stop there, right? So Pharma and French didn't stop there. They're not just happy with those two factors. They looked at other factors as well, and they found that there are more factors that are actually explaining the returns. So in fact, they've updated the three-factor model to a five-factor model. It's called the Pharma and French five-factor model. And further, with more research, they created what is called factor zoo. If you can think of factors as animals, a lot of animals, then factor zoo is kind of the many factors that have been discovered, right? So, and note this word discovered, because factors are always there. It's just that they have been identified over time. And there are other key factors that I would like to explain, and not just value and size. So the other key factors, one is momentum, right? So momentum basically is basically riding on a philosophy that winners will continue to win and losers will continue to lose. And using this philosophy, people have been able to make better returns, and it rides on the fact that markets underreact to new information. It takes time for markets to react to new information, and that's how momentum actually plays out. And similarly, there is another factor called the quality factor, which is probably very straightforward to most of you. It says that firms with higher profitability will receive higher returns. And the last one that I want to explain is low volatility. And here, basically, I think this is a real kicker, because if you see, it essentially says that less volatile stocks will give better risk-adjusted returns, right? So, which is very counterintuitive in one sense or the other. But they the low volatility as a factor has also done very well amongst all the factors that we're going to see. And okay, so all of this is GAN, right? We've talked about, how factors really came about, what these factors are, etc. But we really want to see how did they actually play out in a global arena and also in India. So if I move to the next slide, so here, if you see, globally, factors have really outperformed the markets for a long time now. And if you see, this is stocks, the gray line is stocks global 1800, which represents the developed economies, the 1800 stocks in all the developed economies, including North America, Europe, and Asia. And if you see here, all the factors, right, momentum, value, quality, size, and low volatility, all of them pretty much have consistently beaten the market, which is the gray line, right? And this is not just true with the global or developed economies. They have noticed this in other developing economies as well. And that's how actually factors are defined. So irrespective of the geography, it should work. And when you see this performance in India as well, you see that factors have consistently outperformed the markets over time. And the thing is, right, so based on this outperformance, obviously I don't want you guys to just start investing in factors tomorrow when the markets open, right? So obviously this comes with certain challenges, and one of the major challenges with factors is that they are cyclical in nature. And let me explain that here, right? So if you see here, over different years, it's not just one factor that has been doing well or topping the list, right? So you see different factors coming at the top at different points of time, right? So and one example that I wanted to give is quality. So if you see quality as a factor, it did well in, or it's probably topping the list in 2 years out of, roughly 15 odd years that we have here, right? So that explains the fact that factors are not working all the time. They are working in some seasons. They're not working in some seasons. Or some factors are doing well, some factors are not doing well, right? So how do we really tackle this challenge? And what do we do at FactorLab to address this challenge is what Shekhar is going to talk about. And I'll let him take over from here. Over to you, Shekhar.
Yeah. Can I move on to the next slide, please? All right. So over a period of time, if you have a holding period of, let's say, 7 or 10 years, that's where you see factors outshine handsomely the markets. But holding for a period of, let's say, 7 or 10 years might be difficult for retail investors or in general for any investors to hold. And you see an underperformance during some bouts of different market regimes in single factor exposures. So the better way to do or tackle is to have a multi-factor approach while constructing a portfolio. We do take at least 2 or more factors into consideration and then build your portfolios. There are different ways you can create a multi-factor portfolio. I'll talk about a few. You can have what you call as a barbell strategy. That is, you take 2 pure factors. Let's say you have 50% exposure to momentum stocks and 50% exposure to quality stocks. And then you construct a momentum plus quality barbell approach, where there are 2 pure factors. And then you can also do some kind of double sort. That is, you sort all these stocks first based on, let's say, quality. And then you pick the top 20 percentile or top 25 percentile. And then again, you sort based on momentum or value or whatever factor. And then you create another set of portfolio, which is a double sort. And then there are the third, which is ranking. The third way ranking is basically you sort all the stocks and give a particular factor score. Let's say for quality, you give a score, value, you give a score, low volatility and momentum. And then you calculate the final score of each stock. And then you sort these stocks, and then you pick the top 10% or top 5% based on your holding size. And then you allocate or build that portfolio. Now, I've talked about 3 different such multi-factor strategies, and that's how usually the institutions or in managed portfolios, people create the factor portfolio. The reason to do these multi-factors is that there are certain periods where some factors don't perform. Right? For example, in a situation where there is a good bull market, all the factors are underwhelmed by the momentum factor. Momentum supersedes all the other factors, and you feel that why am I even investing in value or quality when there is a lot of momentum? But when the tide turns and it's a sideways market, that's when low vol strategies start to outperform. Like what we have seen in the last 1.5 to 2 years, the low vol stocks did better than the rest of the other benchmarks. And when there is an early start after the rebound, that is early start of the growth that you see, right? That's where the quality stocks or the deep value stocks tend to outperform, and especially the deep value stocks tend to outperform. When there is severe correction, and post the correction, in the early initial rise, the value stocks do really well. So that's how to avoid any one particular style of factors, a multi-factor approach would be helpful. Moving on to the next slide. Now, some of these factors are, as Deepak mentioned, they're all rule-based. A factor is called as a factor when these rules are defined and can be seen across the geographies, across asset classes, and across time frames. If a factor is prevalent in only certain geographies or certain time periods, then it is not called a factor. It is just called as an anomaly. So only those factors which stand the test of the time and are seen across the geographies are called as factors. And then that's why we have these 5 or 4 common factors well known, that is momentum, low vol, quality, value. In India as well, we track these 4 factors. And over a period of time, some of the factors actually get vanished. For example, in India, the size factor, which was there long back, now is starting to vanish slowly, meaning that the returns that you see by taking an exposure towards small cap stocks is actually underperforming or not giving the same set of results as the large cap stocks. So that is something that we need to keep in mind. And at FactorLab, we have built a backtesting engine to basically cater and see which factors are consistently doing well and how can we harness these strategies into our portfolios. So we have come across a couple of strategies and published on our small cases. Moving on to the next slide. So we use the stress test to see that at which stage of the markets, what factors are having tough times and how do you overcome this? What are the correlations among the factors? There are some factors which have negative correlation to other factors. That's where we'd love to have those 2 factor combinations. For example, a momentum and a value. Momentum and low vol are having negative correlations or low correlations. So basically, you can see that yin and yang between these 2 factors, they try to jumble one across when the markets are moving in different things. So what we have constructed is such multi-factor portfolios which are having negative correlations. Moving on. Yeah. So the first strategy is called as dual momentum, where we have the momentum running across the asset classes, not just equities. We also take into consideration gold, silver, debt, REITs, international, and as well as Indian stocks, and then build a portfolio. Because the universe is very important, the universe of holdings that we choose. And we get a wide spread, and we always see some asset classes always in a momentum. And the next strategy is adaptive asset allocation, where we try to preserve the capital and move it in a more secular fashion, where we give weightages to the asset classes based on the risk priority. Meaning the least volatile asset classes get a higher weightage, and most volatile asset classes get a lesser weightage, and it dynamically adjusts the weight to ensure that the overall NAV trajectory is smooth. Next slide. Yep, I think that's all from our end. We're happy to answer the questions.
Just quickly show you what constitutes an adaptive asset allocation model. So if you see here, this is basically rotating between factors, right? So if you see adaptive asset allocation, it moves between momentum, value, quality, low wall, gold, and debt, right? So in a bull kind of phase, it moves between momentum and value. So in a bear kind of phase, it goes into gold and debt. And in a sideways market, it moves into a quality and low wall factors. So that's how it's not just multi-factor, it is also a multi-asset approach that we are taking here for both strategies. And at any point of time, we take more than 2 ETFs. We basically reduce volatility by allocating more to less volatile ETFs and more to high volatile ETFs. So that's how we are able to keep adaptive asset allocation as a very defensive strategy. I call this the Dravid of our team, who's been very consistent and knows which ball to play and which ball to lead. Right. So on the other hand, the dual momentum strategy is our Sehwag in our portfolio. So if you see here, in a bull kind of scenario, you could actually create a 30 stock portfolio. So it takes 15 stocks from Nifty 100 and 15 stocks from mid small cap 400 when we are actually riding on momentum. And when you go to a sideways kind of market, it could just be Nifty 100 and gold, right? So essentially to diversify between equities and commodities, right? So here we actually do a bi-weekly rebalance, whereas with adaptive asset allocation, we take a monthly rebalance because this is not this doesn't churn a lot.
All right, I'll just quickly give a run through of how Tradl AI can be used for factor-based stock screening. So everyone who has joined us, let me tell you that we are building Tradl AI as an AI trading intelligence platform. It basically is a natural language interface, just like how you interact with ChatGPT, Perplexity, and the likes of all these LLM AI platforms. You can come over here, write a certain prompt if you're seeking certain answers related to the market, if you want to scan certain stocks. This is a tooltip where currently we have two tools live. One is an AI stock screener and an earning reports analyzer. Earning reports analyzer happens to be a qualitative AI engine running on top of the documents that companies publish, be it annual reports, con call transcripts, etc. So you can do qualitative interaction on top of those information and documents. Stock screening is where you can ask certain questions, give certain metrics, and try to see what are the stocks which are satisfying those criteria. Why we have built this in this particular way is because we believe that people should not be dabbling with a lot of filters, a lot of code, etc. The interaction with the data available in the market should be very, very easy to comprehend and easy to analyze. So we were talking about factors. You can simply come up here and write a particular prompt like this. So we know that IT and pharma are two hot sectors right now. IT primarily taking the burn of all the AI advancements, and pharma has become very, very interesting after the Ozempic release that has happened in the Western market as well as in India. So these two sectors are very, very hot. So if you want to sort of identify fundamentally good stocks based on certain factors, you can try to write a prompt like this. Once you write it, what it does is it first tries to come up with a mathematical execution plan. Then it goes on to ask certain metrics for you. For example, if you're asking for PB value, what do you mean out of that particular aspect? Once the prompt is getting confirmed, it will first curate a mathematical execution plan, write up a code for you. So this is the plan that is curated. Now, what it is going to do is it is going to perform these bunch of calculations for you and give you an output table consisting of the stocks that are going to satisfy those criteria. So here we have the stocks. You get to see a lot of data variables coming up, which are calculated based on the market data pipelines that we have integrated. You can take a quick look at the price action. You can convert the list view into a sort of a heat map. Look at multiple parameters in terms of how the stock price is changing or the metrics that were a part of your prompt. So this is how you can use Tradl AI. Beyond the prompt screening, we also have a module called Discovery. So you can quickly go here and check how the stocks are performing every single day. What are the hot stocks? We have a library of more than 50 plus public screens based on multiple things, as well as factors. For example, here in multi-factor, you will find a quality and a momentum screener. If you expand this, you'll see the prompt here and the stocks coming out of the screen as an output. During market hours, we keep refreshing this automatically every single 5 minutes. So during market hours, if you come back to Tradl AI, you can see some of these public screens throwing you newly added stocks. So these are based on the Friday scan. If you want to add a certain layer of question on top of the output that the public screens are giving, you can ask questions here. So this is our discovery module. You can simply click on any stock name and go and check out its stock page. The stock page consists of a lot of information, which is fundamental, technical, price action. You can take a candle view look as well. All the public screens are nothing but signals for you. So you get a quick view over here. We have the factors also listed over here, which was the theme of today's discussion. We have also clarified how are we calculating the scores for each of the factors. The technicals are over here. We also have the earning reports analyzer available for currently the Nifty 50 stocks. So you can see an AI summary of all the documents over here. If you want to ask certain questions on top of these documents, you can simply write a prompt here and do the analysis. So this is what we have created in terms of Tradl AI's first version. We also have a playground. This is like a dynamic watch list. Any screen that you create, any prompt that you generate and scan, you can save it in your playground and take a quick look during market hours like this. We also have an agentic news feed called Market Buzz, where all the news pieces coming in are analyzed by an AI. It picks up all the affected tickers. It tells you the sentiment of the news. So this is something that we have built so far. We are also currently working on expanding the tool coverage. So there will be multiple other tools coming up in future. So people who have explored Tradl AI, keep on using it. People who are new, you can go and sign up on Tradl.in. That's where we are currently offering all of this. This is currently free. There is no cost or subscription fee involved. It's an absolutely free platform. So yeah, that's all about Tradl AI and how you can use it for factor-based screening and a certain bunch of other AI-driven analysis. Now, maybe we can take up questions. So I'll go in the starting order. The first question was from Pranav. He's asking, isn't it that small caps also usually outperform large caps because they have more window and room to expand the business? Is that something which is right, or there are certain other aspects associated to it?
Yeah, I'll answer that question, Pranav. So yes, small caps was the first size that was discovered as an anomaly, that small caps tend to outperform the large caps because there is the information arbitrage available in small caps, which many of the research analysts or maybe the practitioners will not cover small caps. So there's a lot of room for it to grow. But as time has progressed, this information arbitrage has gone, and I'm sharing my screen to show you the size factor, and it has now diminished. So if you see, this is the just like following French 5 factors. In our Indian version also, IIM Ahmedabad maintains the list of factors and periodically tracks every month how are the factors doing. Since the inception of 1993, they started to calculate this data. Now, if you see, the factor which is not performing well is this one, the cyan color or the light blue color one, which is the size factor. So size factor essentially says like you pick the top stocks which are, let's say, on the large cap side, and let's say, and vice versa on the small cap side, and you see that how are the competition doing well, no? Whether let's say the small cap one is not performing than the large cap one, you see that actually it is not doing well even than the markets. So if it is in fact it is negative, meaning that in fact the larger cap ones do well than the small cap or micro cap ones. So size as a factor in India is no more prevalent. The factors which are there still are the low vol, quality, value, and momentum. I hope that was answered.
All right. Thanks, Mani. We can pick the next question. The next question is from Shubham himself. How can we identify these business cycles, market cycles, and investor sentiment? Are there any good metrics to look at it? And how do you guys do that? While you are running a small case, how do you guys struggle or do it more efficiently than the rest of us in terms of identifying business cycles, market cycles, and investor sentiments? So, any scoop on that?
Sure. So, market cycles or business cycles are you can predict them in different ways. Not predict them, you can understand or gauge them in a different ways. Let's say some use macroeconomic filters. like maybe a GDP or employment rate as macro as they can, and some use a sector level or a sectoral level metrics to see whether if it is a metals or a mining industry, what is the what is the operating ratio, what is the percentage in terms of the factory's output or the factory's output that is being produced. And in case of banks, let's say what is the percentage of NPA. So there can be different fundamental level nuances for each business cycle. But if you're looking at a quant perspective or a factor perspective, factors, as I mentioned, are rules based, they're defined, and they don't change at all. So they're static in those nature. So since we are relying on these factors, we have certain trends about how these factors have outperformed over a period of time. And we have certain levels of thresholds of when are these factors, especially in the difficult situations, are overburdened or let's say are now undervalued. So one such ratio that I would want to highlight is the CAPE ratio. So you can read about CAPE ratio in a research paper published by Rajan Raju, which is basically cyclically adjusted PE ratio. So this CAPE ratio has known to be a very good predictor of future returns. So this is the research paper. I'll share it in the link also. Maybe you can quickly go through it later. So there's a very good research paper written on the predictive power of CAPE ratio. CAPE ratio is simple as the P ratio, but just that it is cyclically adjusted P ratio, so that the P ratios actually tend to change over a period of time. Now, what they do is they adjust it to ensure that the inflation is taken into consideration over a 10-year period and the P ratios are normalized. So this CAPE ratio actually predicts based on the levels of CAPE ratio that we are. It predicts whether it is a sideways market or a bull market or a bear market. So this is the chart that I want to show specifically. That each dot represents one particular CAPE ratio, and on the x-axis and on the y-axis is the returns. So as you see, it is having a downward slope. Basically, the higher the CAPE ratio, the lesser are going to be the returns. So similarly, Ahmedabad, again, as I mentioned, they also publish the CAPE ratios on a monthly basis, and you can check them. What is the current CAPE ratio? I'll just share these articles so that it will be helpful if you want to check. I hope you're able to see my screen.
Yeah, visible.
Yeah, this is the monthly CAPE ratio of India. Right now, we are at a very elevated level. I think this is a better way to look at. So right now, we are 1 standard deviation away from the usual CAPE value levels. This is the BSE Sensex, and this is the NSE Sensex. The similar levels of values were seen back in 2008 bull run. Now, though it has subsided at least considerably, meeting the median value for the last 1.5 to 2 years, but if you see at an overall larger context, we are still elevated in that sense. Maybe it is a new normal, we do not know, because India is a growing country. That's how you can roughly get what is the business cycle that we are at now.
Got it. Thanks, Shekhar. That was fairly detailed. We'll quickly pick up the remaining questions. Next one is from Nipun. He's asking, can you tell us a bit about the BARA US equity model, if you're aware of that? And is there any similar factor model for Indian stocks?
Yeah, so I haven't really seen this before, but it looks like it's a multi-factor model, that just not looks at momentum or value, but looking at a multitude of factors. I think in India as well, there are quite a few multi-factor approaches. But what we've seen is that, when we talk to these institutions, large institutions who actually come up with these strategies, they do add a lot of subjectivity to their to the model or to the strategy. A lot of not just purely quant based, but I also noticed that there is some intuition that is also coming along. So at FactorLab as well, we do have the small case strategies, which are purely rules driven, data driven. And so we are just one example of multi-factors in India. And apart from that, there are multi-factor indices that you can look at. So if you go to Nifty indices website, there you'll see a total returns index for all the indices, all the Nifty indices, be it market indices, sectoral indices. You'll also find factor based on they actually named as strategy indices in Nifty indices website, and you can there follow what are the different factor indices and how are they performing. So just quickly sharing my screen. So this is Nifty indices. So here they try to explain all the different indices. So these are broad-based indices, sectoral, thematic, and then you see here the strategy indices, and you see here the different factors, momentum, alpha, low wall, right? So here is you see a combination of two factors here, alpha and low wall. And you see here a combination of three factors like alpha, quality, and low wall. So, but you also need to find if there is an institution which actually have an ETF for this or an index fund for this. Some of them they do have, some of them they don't have any. So for those, we have to create our own DIY strategy model. So hopefully that answers the question.
Yep. Thanks, Mani. The next one is from Rajiv sir. He's asking, how is it decided that market is, sorry, I think it's the later one. Yeah, the first question was, what system is being used to assess value of a stock? Any metrics that you guys follow? In terms of how do you define the value factor and what is the underlying metrics involved in terms of computing the value of a stock?
Got it. Well, I think I'll answer this by showing what NIC in fact uses. We use a similar kind of because we don't want to. Some of the factor construction are in-house, which is proprietary to us, and some of them we actually rely on what is already proven and available well in the listed or documented space. So NIC maintains these strategy indices like Deepak had mentioned, right? So what you can do is I'll show what the value factor that is talking about. Let's say there is a value factor. Yeah, let's take this value factor. If I go to value 30. Now, if you want to know the methodology, I'll get the methodology, but I wanted to show how the institutions do, so that we can start from can have a starting point. So you just go to the website and you can scroll down to see the methodology that they publish. They publish for each value as a factor. Let's say the Nifty value 30 consists of 30 components from its parents selected based on the value score. The value score is basically a combination of price to earnings, book value, and other combinations. I think my screen is stuck.
Frozen. Let me share my screen. So are you referring to the
Yeah. You can scroll down.
You can stop sharing your screen. Okay, I got stuck. Are you guys able to screen?
Yeah.
Yeah. Okay. Yeah. Go on.
Yeah. If you search for let's say any factor, how are they constructed, not just value, and they mention the exact the methodology and the logic that they use to calculate that factor. So you see the stock selection criteria. What are they using? A combination of these, which are dividend yield, price to earnings, price to ratio, are available. This is pretty exhaustive. It is open source. And how do you do these scores? How do you adjust for anomalies? All is already taken care of.
Got it. The next one is from Rajiv sir again. What kind of metrics do we use to assess the market volatility, whether the market is bullish or sideways? So in terms of volatility, what are the metrics or factors that we can look at?
There are a couple of, in fact, two metrics that we do. One is the VIX, or the implied volatility we'll be able to get based on the VIX index. The second is the the standard deviation or volatility of its own price historically. So both these help us in identifying what is the kind of volatility setup that we're currently situated in. To take the last 1 year's standard deviation of the price, daily change movement of the price.
Nilesh, just 1 minute.
Yeah, sir. Please go ahead.
In this question, see, when the selection is being done, like asset allocation or the other one, in both our top selection was there for bull, bear, or sideways. So while implementing your strategies, is the person required to select that, or you are doing automatically? That is because see, if the as a user, if I have to use, then I have no metrics to select myself. So that is what is the main.
Yeah, it is automatic, sir. We basically what you get at the end of, I mean, once you subscribe to these strategies, what you get at the end of the day is the stocks. So each strategy has its own return, expected return, and risk that it comes with. Adaptive asset allocation is a more defensive strategy, and dual momentum is more an aggressive strategy. But here you don't select, whether you want to go with bull or when we give the recommendations on what stocks you can go with. So yeah, it's entirely automatic.
Okay, fine. Thank you.
Okay, thanks. The next one is from Mayank. Mayank is asking, considering the expense ratio that we have in mutual funds, how much capital one should have when investing in small cases to justify the subscription cost? I think this is a very, very relevant question for anyone who is, evaluating small cases as an alternate or as a diversification option available in the market beyond mutual fund portfolios. And since you guys are running a small case, I think it's a very valid question for you to also answer. So how do we evaluate how much should the capital allocation be from a subscriber point of view to adjust with the costs? Because while we do rebalancing in small cases, and for example, you guys mentioned that your small cases are, let's say, bi-weekly rebalanced. So there is definitely going to be an STCG involved whenever a stock is getting sold in the rebalancing event. So Mayank is just asking, how do you see the pros and cons of mutual funds versus small cases, and how does the rebalancing work for people who have subscribed for the small case? Does it happen manually, or the small case manager does it, or the platform sends a nudge to automatically rebalance? So just a quick run through on small case rebalancing and pros and cons in terms of mutual fund versus small case.
Sure. I think that was a loaded question. I'll try to unpack it one by one. So first is, how does small case function? Small case is an aggregator of different portfolio managers, and you can subscribe to their strategies. And once you subscribe to the strategies, right, what happens is whenever there is a rebalance that is coming in, they'll push it to your app, to your email, to your WhatsApp, that these are the changes that you need to do. And the beauty of small case is basically it is already linked with your Demat account. So only when you actually link your Demat account with a small case, only then you'll be able to subscribe. Now, once the Demat is already linked, when the nudge is made, right, you click on rebalance, and automatically the orders get prepared, like what stocks to sell, what stocks to buy, in what proportions, at what price is already there. You just need to tap on it, and the execution happens. Small case end. So that is how the rebalancing happens. Now, what does a small case manager do? Basically, we manage 4 things. One, what to buy, listen, which stocks to buy, and when to buy, when to enter into these stocks, and when to exit, and finally, how much to allocate amongst these stocks. So that all 4 are managed by the portfolio manager, and you will be just executing or clicking on the rebalancing button for the sake of simplicity, and that's how it is getting managed. Now, coming to the cost side of it, that's a good question. In mutual funds, what happens is whatever transactions that fund manager does, for example, if they're selling a stock or buying a stock, and if there's any LTCG or STCG incurred, right, they actually don't pay the tax. So it is all getting added to the NAV if it is a growth strategy. Now, if they are again reinvesting back into the fund, so that's the advantage of a mutual fund. And usually mutual funds have the expense ratios anywhere between 0.5 to 2%, 0.5% to 2%. Most of them would lie around 1.2%. You can think 1% as a standard in mutual fund in terms of expense ratio. So if you were to make a similar comparison in small case, whenever you're deploying the money, in here, since you're paying a subscription fee upfront, right? Let's say you're paying a subscription fee of 5K or 10K, let's say, then if it were to make an apple to apple comparison, at least the investment amount should be such that the subscription cost comes down to 1% of the AUM. So let's say you are subscribing to a small case strategy by paying 10,000 as a subscription fee, but you're only investing 1 lakh, then actually you're paying 10% as the expense ratio. If the subscription fee is 10K, a recommended amount should be 10 lakhs. If the subscription amount is 5,000, the invested amount should be 5 lakhs. That's the bare minimum, and that's when you actually see the benefit of a small case kicking in.
Got it. I think this is fairly detailed. Let me pick up the next one. This is again from Pranav. He is asking, how do you differentiate between business cycles? For example, country X might temporarily ban fertilizers from country Y, which results in a rally in fertilizer stocks in country X, and eventually geopolitical tensions are resolved and those restrictions are lifted from country Y, resulting in cooling of the rally. This whole phenomena might occur over a 6-month to an 18-month kind of a time frame. But it seems to be more temporary situation, but not a bullish business cycle. So while we are looking about cyclicality in a particular sector as a factor, how do we remove the aspect of these kind of anomalies which can arise due to certain external factors like geopolitics, etc., etc. So basically, how do we remove noise from factors is the theme of the question.
Right. So there are 2 parts that we do while constructing a portfolio. One is we usually have a set of stocks, not few stocks. It is always a selection of 30 stocks that we have in constructing a portfolio. Now, how did we decide 30 stocks and how does it help in this question is, the number of stocks in a portfolio or while constructing a factor plays a very important function in determining the returns, risk-adjusted returns. You must have read a famous research publication that if you hold a concentrated set of stocks, that is less than 10 or 15 stocks, you actually have a high idiosyncratic risk, that is stock-specific risk. So anything bad happens to that stock, or any news, or a sector-specific news, or a management-related news, then you are deeply hurt by that stock. The moment you start to increase the number of holdings of portfolio stocks more than 15 to 20 to 25 and up to 30, you are getting the advantage of reducing the portfolio's volatility to as much as the overall market's volatility, at the same time increasing the returns. The moment you increase more than 30, and the sweet spot, you increase more than 30, actually you don't end up getting the benefits of diversification, but you also reduce the market returns. Now that the sweet spot we try to maintain the number of stocks 50 to 30. Now how does it help in this aspect is, if any sector or a stock is coming into our radar or a list of our factors, let's say we run a momentum or a based strategy, right? And some of the times you don't even know what is the reason that is causing the surge in price. Only it is known after certain amount of time or quarters have elapsed that, hey, this is because of so and so reason that this sector has been rallying. Let's say defense has rallied, and maybe let's say PSUs are rallying. So some of the time you don't even know what is the cause, only after some time has elapsed. Now, especially in these cases, the factors will help because the factors are rule-based. They don't worry on the objectivity of why it is happening. They pick what that is, and that gets entered into the portfolio. So that is the reason we are not bothered about the stories, what is coming in. We are more bothered about whether does it come into a filtration. And even if it comes into a filtration, we are not bothered that it might cause havoc, because we know that the allocation for a particular stock or sector is limited 15 to 30, and it doesn't play havoc. And this mixture of 15 to 30 stocks over a period of time will continue to do well. That is what has been seen in the backtested data.
And just to add to that, I think that's the dichotomy between a quant investor and a fundamental investor, right? So fundamental investor will try to, go through each and every news, every, article out there, trying to understand explain what is happening behind the scenes to understand the returns. Quant is more about, if purely rule-based or signal-based. And what we do is we have developed a comprehensive backtesting engine internally, and we look at different parameters. So not just number of stocks, right? So like what Shekhar mentioned, we also look at what is the appropriate look back period, what is the appropriate rebalance period that we need to look at to understand what would be the optimal risk adjusted returns, right? So we backtested for the last 15 years. If we hold 10 stocks, what would be the risk adjusted returns? If we hold 50 stocks, what would be the risk adjusted return? So for each of these different parameters, we try to understand where do we see a plateau, and that we kind of get to that optimal number, and then obviously we do some paper trading, our own personal investing, and before we actually launch a strategy. So this is what goes behind the scenes.
Got it. Thanks, both of you. I think that was again fairly detailed. There are not more questions, but I'll just take the relevant ones. Anupreet is asking, how is the momentum factor calculated in a dual momentum framework? Which factor is used? Is it a time series momentum component or something else? How do you also define bull, bear, sideways market regimes when you look at a regime model? Do you use a formal regime model, or is it a combination of time series momentum and cross-sectional momentum? And if a regime model is used, is it Markovian in structure? So it's a fairly technical question. Anupreet's background is in quant, so yes, that explains the depth of the question. But over to you guys if you always want to sort of pick this up. We'll try to keep short because there are a bunch of other questions also, and we have more time. Yeah.
So definitely, I'll keep it short. Thanks, Anupreet ji. Anupreet ji also runs a great platform called Beyond IRR. If anyone is interested, you can check out. So I'll answer this question first. Yes, ours is a momentum strategy, which is based on the price return of the previous 12 months. And it is an exponential weighting that we do. So to give an example of exponential weighting, the recent past carries a lot more weight than the distant past. That is one. And secondly, with respect to dual momentum, yes, we use a combination of cross-sectional as well as time series momentum. What we mean by cross-sectional and time series is that if you're looking momentum or a price return of a strategy with itself, let's say you're considering Nifty 50 and you see whether to invest in or not. Let's say you take last 6 months and 12 months returns and you see that Nifty over the last 6 and 12 months has given 8% and 12%. And you say, yes, it is in momentum, it has given a positive returns. And then you just go ahead and buy. That is time series with respect to itself. But if you're looking cross-section, that is you're comparing Nifty against gold. Nifty has given in the last 1 year, let's say 10%. Gold has given 20%. Momentum looks to be in favor of gold. Let's go ahead and buy and gold. That is cross-section. So use a combination of these two, so that we're not just comparing with itself, but also with other asset classes. And most importantly, we always compare it with the risk-free rate, which we assume to be 6%. If any strategy is not even giving 6%, or asset class is not giving 6%, that doesn't even come into our consideration set. With respect to the Markovian chain, I think regime we don't use Markovian. The reason because it is probabilistic in nature. We want more binary output, whether to exit or enter. A signal should be clear. So we use more signals and trend-based rules. Yeah.
Got it. Next question is, okay. It is from Shilpa. How can we find CAPE ratio for a stock? I think you guys showed the IIM Ahmedabad repository. Maybe the link can be dropped in the chat once again. And if there are any other sources to references to look at, maybe you can mention that. Sunil sir is asking, do you use fusion of statistical and fundamentals in your models by applying quant methods on fundamental factors? Do you want to touch upon that and elaborate?
That is purely qualitative in nature, and some of the fundamental metrics also we take into consideration.
Okay, got it. One last question. This is from Rishabh. Rishabh is asking, say the rebalancing of a small case happens on day 1, we are on day 20th. Between that, the factors have changed. Now, how will this scenario impact the analysis done on day 1? Because you would have, published a certain rebalancing recommendation based on whatever analysis you would have done until that point in time. Now, between that time of you publishing that rebalancing recommendation and the user accepting and acting on it, let's say a certain time has passed, and let's say those factors or underlying contributing, metrics have changed. So how will it impact the user? Will it just show automatically in the rebalancing recommendation the new stocks would come up based on whatever has changed? Or will it be the same thing that you had recommended on, let's say, day 1, but user is still acting on day 20, but the composition remains same, irrespective of whatever has changed in the market? So just a point of view on this.
So we recommend to rebalance it as quickly as possible, because since we do a bi-weekly rebalance, sometimes in fact most of the times the stocks don't even get changed, even if it is 2 weeks rebalance. So for example, the last 1.5 to 2 months, our composition has remained the same. So someone who is not rebalanced would not have made not seen much difference. But let's say this becomes critical when there are times where these situations are changing. Let's say if it is a COVID crash, or we push a rebalance, and if someone is acting late by, let's say, 1 or 2, 3 days, then a huge difference might be seen. So in most of the cases, it should not matter if you're rebalancing slowly, doesn't matter. But we recommend to do it at least in 1 to 2 days. And if it is more than difficult situations, it is important to as a response.
Got it. I think we are done mostly with all the questions. If anyone is feeling there is anything that is left, please feel free to point it out in the chat. Otherwise, I think we really had a very fairly detailed Q&A, more detailed than the entire session that we delivered, and very interesting to see some of these interesting questions coming up from the audiences. We touched upon aspects of small case. We touched upon the aspects of what factors are, what goes inside deciding and researching upon those factors, how to look at those data, what are the sources. And we also touched upon some of the technical concepts, like whether in terms of evaluating a particular factor, are you going to look at a time series data or something else? For those people who were also asking a bunch of questions around Tradl, so I'll just sort of summarize all it in one go. So on Tradl, we have created an AI trading intelligence platform. It's a natural language interface. You can write prompts to perform certain research, analysis, a real-time intelligence that is delivered to you. We also have a library of public screens tagged along with bearish, bullish screens, as Alok mentioned in the chat, wherein you get to see if, let's say, the markets are currently in bearish phase, for example, with all the sentiments around war is ongoing over the weekend. We do see that there might be certain fall happening over the early next week. So you can simply go to Tradl, go to the discovery section and check out the bearish screens and spot your stocks which you find interesting enough. And then you can pick it up for, let's say, your intraday trading and, F&O trading. We're also going to build, our own backtesting engine, which is a no-code, solution and an experience. Once you are doing any screening, on top of that, you can backtest it over a period of time, let's say 30 days, 100 days, 200 days. Something that Mani and Shekhar both use at an institutional level when they run this small case. But for somebody who is at an individual level looking to do certain analysis and backtest it, we are going to come up with that as a simple tool. And there will be a new F&O analyzer tool coming soon. So these are a bunch of tools that are currently under development. We might launch it towards the end of March. So stay tuned. People who have already explored Tradl AI, the web link is dropped in the chat. Alok can mention it again. So it's tradl.in. And all these new tools will be coming up. We'll keep sharing it in our community. We'll keep hosting a bunch of other expert series also. This was our second edition. Thank you so much, Mani and Shekhar. Thanks for your time. We really enjoyed discussing and learning from your expertise and the kind of things that you guys operate. It's very, very humbling and inspiring to see, somebody transitioning from a corporate career, exploring a completely new domain and, becoming experts at it and launching a very, very innovative product like a small case, which you guys shared. We will definitely share the links of the small case as well as all the assets that we discussed during the session, along with the presentation with all the participants. So thank you so much, everyone, for joining in. Feel free to reach out to us. Most of us are connected over WhatsApp, our WhatsApp community, etc. So for anything, do reach us on WhatsApp or our emails, and we'll share the assets by the end of the day. Thank you so much again, Mani and Shekhar. Thank you so much for taking out time. It was lovely hosting you guys.
Thank you. Thanks a lot. Have a nice day.
Thanks a lot.
Bye, everyone. See you soon.
Bye.